Digital Asset Treasuries. Bitcoin's institutional test case. Digital Asset Treasuries, DATs, are the first laboratories testing how a decentralized asset can operate as productive capital within the architecture of corporate finance, argues Sygnum Bank CIO Fabian Dori. A small but growing class of companies is moving beyond holding Bitcoin as a static reserve. They are integrating it into capital strategy, using it to raise funds, secure credit, and engineer returns. These digital asset treasuries, DATs, are the first laboratories testing how a decentralized asset can operate as productive capital within the architecture of corporate finance. The phenomenon began with strategy but has since broadened. Japan's Metaplanet, France's The Blockchain Group, and Europe's 21 Capital are major examples of companies that have each developed models that position Bitcoin not just as an investment, but as a working financial instrument. Their experiments are accelerating a larger process: the financialization of Bitcoin, and potentially other tokens as well. Historically, Bitcoin functioned as an alternative store of value, an uncorrelated hedge against monetary debasement. DATs are expanding that equation. By using Bitcoin to access liquidity through loans, convertible debt, or fund structures, they are treating it as programmable collateral and a productive asset. This shift from ownership to utilization marks Bitcoin's entry into mainstream corporate finance. Convertible issuance has become a common feature of this strategy. Zero-coupon bonds and equity-linked notes allow corporates to raise fiat capital while maintaining upside exposure to Bitcoin's appreciation. Investors gain asymmetric payoff potential, while issuers optimize their cost of capital. It is an inversion of the traditional view that volatility is purely a risk factor. In this new model, upside volatility becomes part of the value proposition. To evaluate these new treasury models, investors have begun to rely on a metric known as the market net asset value, or MNAV, a measure of how effectively a company converts digital holdings into real, productive capital. The key to understanding the sustainability of these strategies lies in the market net asset value, or MNAV multiple. It bridges traditional valuation logic with crypto market dynamics. The MNAV of a DAT correlates directly with the underlying asset's price, which explains much of the short-term volatility in these companies' equity valuations. Yet what matters most is not the absolute level of MNAV, but the multiple investors are willing to assign to it. That multiple reflects confidence in a firm's ability to create alpha beyond Bitcoin's base performance through disciplined capital allocation, balance sheet engineering, and incremental yield generation. When MNAV multiples compress on average, it signals a market that is rewarding risk management over speculation. When the multiple declines for a specific company, it highlights idiosyncratic risks. Recent data shows both patterns. DATs that pursued aggressive debt issuance or relied on frequent equity dilution have seen their MNAV multiples fall below 1x, implying investor skepticism about the sustainability of their approach. Conversely, firms maintaining liquidity buffers and diversified treasury structures are preserving their premium, although on a somewhat reduced level, showing that the market values prudence and operational discipline even in a high beta environment. In this sense, MNAV functions as the new price-to-book ratio for digital asset finance, an institutional yardstick distinguishing financial stewardship from opportunism. Bitcoin's integration into treasury management is also imposing fresh constraints. Share prices of DATs now move in near lockstep with Bitcoin, amplifying volatility. That linkage is unavoidable, but the difference between fragility and resilience lies in structure. How a company manages its debt, equity issuance, and liquidity in relation to its crypto exposure. Well-governed DATs are borrowing lessons from traditional finance, stress-testing leverage ratios, setting hedging limits, implementing far-sighted cash flow and liquidity management schemes, and establishing risk committees to manage their crypto positions with the same rigor applied to FX, commodities, and other traditional assets. This is how Bitcoin transitions from a speculative position into a governed component of financial infrastructure. A similar rebalancing is visible beyond corporates. Different crypto foundations now manage treasuries combining native tokens with traditional assets such as cash, ETFs, and fixed income. Their objective is not to reduce digital exposure but to stabilize it, an approach identical in logic to multi-asset portfolio theory. In traditional finance, asset managers diversify between currencies, commodities, and credit to optimize liquidity and duration. DATs are now replicating this logic on-chain, blending native and fiat assets to achieve the same end. The difference is that Bitcoin is no longer peripheral to that process. It sits at its core. These dynamics are no longer confined to the private sector. The U.S. government announcing a strategic Bitcoin reserve, first U.S. states such as New Hampshire or Texas following suit, or Luxembourg's intergenerational sovereign wealth fund investing 1% of its holdings in Bitcoin are modest steps. But they illustrate how the adoption of Bitcoin from a store of value over a programmable collateral to ultimately a productive asset, as pioneered by corporates, may scale into public finance too. When state or institutional treasuries begin holding Bitcoin as part of long-term reserves, the asset moves from speculative wealth into the category of usable financial infrastructure. At that point, the conversation is no longer about adoption but integration, how to manage, lend, and collateralize Bitcoin within regulated frameworks. Bitcoin will remain volatile. That is its nature. But volatility does not preclude utility. It simply demands sophistication. More funds, loans, derivative markets, and structured products are being built around it, each adding depth to a maturing market. DATs are where this new system is being pressure tested first. Their success will depend not on how much Bitcoin they accumulate, but on how effectively they convert volatility into capital efficiency, using transparency, balanced reserves, and disciplined treasury management to build trust. In that sense, digital asset treasuries can be seen as a proving ground for Bitcoin's next step toward institutional adoption. Their evolution will tell us how quickly the world's first digital asset can become not only a store of value, but a functioning building block of modern finance.